Guys, my name is Dr. Rodriguez. I'm joined today by Momentum Multifamily. So, if you've ever wondered how to diversify from a W-2 income into passive income, how to get started, learn concepts and all that, you've come to the right place. So, I'm the founder of Cardio Real Estate Investments. I'm a full-time cardiac electrophysiologist. I also have three kids. But this is the primary vehicle and mechanism that I use to generate, again, tax advantage, tax efficient passive income, and really with the focus of intergenerational wealth. So I have the privilege here of being joined by both Dustin Miles and Hayden Harrington. They are the founding partners of Momentum Multifamily. They're a fantastic duo. I've had the pleasure of touring some of their facilities and all that and learning a lot about them. It's with great privilege here that I get to introduce them, but essentially we're going to go over, there are free ebooks that I've written and a whole 9-part investing academy that you have access to when you sign up for our newsletter to really break down the core concepts. But it's important to also put it into practice. Okay. So they're going to walk us through. They've done many deals that have gone already full cycle in challenging markets and have still come out ahead because of their core principles. So they're going to walk us through one of their more recent deals. Again, a value add strategy, increasing the value of the project and allows you to own multifamily commercial assets without the day-to-day headaches of actually operating it yourself. So Dustin, Hayden?
Yeah, great. I guess do a quick introduction on my end, hand it over to Hayden, and then maybe kind of jump into that deal we were talking about. But yeah, Dustin Miles. I live in Fort Worth. Grew up here. Backgrounds in engineering. Used to work at Lockheed Martin, so I used to head out to Marietta actually a little bit. And then, yeah, I was an engineer for a number of years, got into multifamily actually 2012. So I like dip my toes in the water. So I invested passively and I also signed all loan and then put my first deal together 2014 and complete a total of 18 deals and sold 9 of them and about to be under contract to sell number 10. So pass it over to you, Hayden.
Congratulations.
Awesome. Yeah, excited to be here. So again, my name's Hayden Harrington. I'm based here in Conroe, Texas on the north side. I've been in real estate really my whole life. I got started doing it. I really got dragged into it by my dad because he was an engineer by trade and liked to figure out how to do everything himself. And as a result, I was his help along the way, doing single family rentals and flips, and just got tired of dealing with it. And I had a hard time seeing how do we scale this? And it just takes a lot of work, takes a lot of time. We had good tenants, we had bad tenants, and that just seemed like a lot of risk. And it really seemed attractive to try to venture into the multifamily space where you could work on the business rather than in the business, right? But it's still tied into that residential housing that it's one of the main essentials, food, water, and shelter that everybody needs. And I ended up meeting Dustin back in, I think it was late 2018. So almost 8 years ago now, and we teamed up to start Momentum. And we've currently got a little over 1,800 units here in Houston, and we've got another on the way. So we're excited to continue to grow the portfolio. But we've been real strategic about how we've grown our portfolio and how we've gone about that. Because at every level of scale, there's different problems that you have to solve. It's just operating any other business because each of these communities is a business on its own. We like to look at it as almost like a we take a franchise approach to operating our apartment communities, and how you're able to do that and how you're able to scale is a lot of what we'll get into here today. But we think it's one of the best vehicles of building wealth in general. Again, it's one of those essential needs that everybody has to have. And we're at an interesting time in the cycle where we think there's a lot of great opportunities out there that well capitalized, good operators can take advantage of right now.
Yeah, so we can, if you want, yeah, sir, we
Yeah,
can go ahead and just hop in. I'll share my
sounds great.
screen
Yeah.
and then go from there. Awesome. Hopefully you guys can see my screen okay. So I guess hopping on what Hayden was saying as far as being strategic. So this is our portfolio, as Hayden mentioned, a little over 1,800 units. And yeah, want to be strategic. So this is around Houston. Just a few things that you'll notice that there's some clusters around. So there's 5 assets. There's, I can't, 12, 1,300 units, quite a few units here. This is another pocket northwest. I have a few hundred units there. And then Rosenberg, we're looking to kind of add more units over there. So we like to cluster things together. And we have enough of a presence here. We actually have a billboard on the freeway, just kind of fun. But the only reason why we're able to even think about that is because we have scale. And so we're able to spread those costs over a bunch of assets. Otherwise, it's not really possible. But there's a lot of other just reasons for clustering assets. Obviously, so visiting the properties is extremely important, and it makes it a whole lot easier if they're all very close together. And so asset management makes it a whole lot easier there. And just from a practical standpoint of life, where people get sick or their kids get sick or whatever, and they can't make work that day, or just life happens, right? And because we have a large presence, if we need to, we can send over someone from one property to another property to help out as needed. Yeah, Hayden, I don't know if there's anything else you want to kind of touch on here.
Yeah, I think that's a huge point because at the end of the day, we're in the people business and life happens, right? So there's always something that's happening around our portfolio. And when you have resources available, you can help mitigate those risks of when things go wrong. Because it's not a matter of if, it's a matter of when in this business.
Yeah.
And so having the scale, having the resources at your disposal to address those items as they come up. And these are people's lives, these are people's homes, right? You can never predict what's going to happen, but something's going to happen, right? And by growing this way, we're able to mitigate those risks as we scale as well. So we're not buying all over the country. We're not buying assets that are 3 hours apart from each other, and it takes a week of travel just to see our portfolio, right? I can see, I'm in Conroe, which is just north of the Woodlands there on the north end of this map.
Nice.
And I can hit all 5 of our northeastern properties in one day if I want to. That makes a huge difference. And then additionally, we're able to train all of our staff members the same. We're able to have the same uniforms. We're able to have the same procedures across the board. And so when we make one change, we roll that out everywhere, right? We don't have to reinvent the wheel. And these are all the different things that as operators, I think everybody needs to think about. And it's something that we really care about because at the end of the day, these are people's homes and we take that so seriously. And we want them to be excited to come home, excited for their kids to invite their friends over and show them where they live, right? And play with the amenities and make those memories, right? And so it's really meaningful to us. The Henry actually comes from Dustin's son's name is Henry. So that's where that even came from.
Awesome. Awesome. So no put, and it's refreshing that it's not just profits or chasing the bottom line, that you are very cognizant that I actually grew up in apartments coming from pretty humble backgrounds in South Florida, and that's extremely important. And what is novel, or at least that I personally haven't seen, is the franchise model that you touched on. That I think is very powerful in a lot of different businesses, but employed in a multifamily space is actually pretty novel. I don't think I've seen that before, but it allows for marketing, branding to have a certain kind of threshold and a pedigree there. So can you expound a little bit about, are there different price points that Class A, Class B, Class so on and so forth properties that are on that, or?
I'd say a lot of these are on a pretty equal footing for the most part. I'd say they're all kind of A minus, B plus. The Henry Lake Houston is the one I guess maybe point to. It's on the upper end of that threshold. But and that's what's really interesting and really neat about it is, so if we have, let's just say for instance, because the Henry at New Forest and the Henry at Liberty Hills actually share a fence line.
Mm-hmm.
And so we can actually share traffic if for whatever reason they go into the Henry at New Forest and they're like, hey, I want a 3-bedroom, and their New Forest doesn't have 3 bedrooms, so Liberty Hills does. And so that's an
Nice.
easy to then send them right down the street. So we're able to I guess in our minds, capture all the traffic
Yeah.
that comes in. Because if we don't have something, we probably have another property down the street that does.
Yeah. And with the franchise models, so do you have set colors and like branding, if you will, and with your, I imagine like developers and furbishing properties, you probably have a certain aesthetic that you replicate in property to property, or?
Yeah, and if Dustin, if you want to go through maybe the next few slides, you can start to get an idea of that. So you can see we've got similar colors, similar vintage properties, as you saw from the map. They're in similar areas in the suburban markets. So this is all by design. Our pop of color here is In the Navy by Sherwin-Williams. So we put it on all of our doors, all the shutters, all the patio doors. That property on the right there, Henry New Forest, actually just got painted, so it now looks different than that picture. And it's now got our color scheme on it, right? So 100%. We want, when you step in a Henry, we want you to know that you're in a Henry, right?
Nice.
And we want the aesthetics to be similar. When you walk into a clubhouse, each of them is a little bit different. Obviously, they're different properties, but we use the same kind of flooring, the same paint, similar style furniture. We've got an interior designer that we work with on all these projects that knows the vision that we're trying to execute here. And additionally, we have a very defined buy box where we're not going after a 1960s deal and then a 2025 deal and then a 1970s. We're not going back and forth, bouncing all around, right? We say no a lot. And I think that's really important.
Good.
Not just chasing numbers on a spreadsheet. And as we've alluded to, how we're actually going to operate this is so important to us. And so that's what we're really leading with. And then it's got to be a reflection of the brand too. If we always ask that question of, if we were to buy this, would it fit in with all the other properties, right? Can we make it have the same aesthetic, the same feel that when people step in the front door, they know, oh, I've seen this before. I've been in a Henry, right? Actually, three of our properties are actually the same builder. So we do kind of chase similar builders.
Good. Good.
And funny enough, the guy that built those, I went to college with him. We were both engineers. So
Nice.
small world.
Man, it is a small world. Awesome. And what's your general approach? Is it more like a value add from the sounds of it? And maybe can you walk us through an example of how your process, you taken over a property, what are the higher ticket items? How do you triage it? And then ultimately, how do you brand it?
Sure. Yeah, we can jump into this property. So this case study that we have in front of you is actually the Henry Ranchstone. So it's a 1993 vintage, 148 unit community in Northwest Houston in the Cypress area. We really liked it because it had a lot of character. You can kind of see on the left side of there, it's got those beautiful bay windows. It's got those brownstone style steps with the Spanish tile on them and everything. And they've got some really unique floor plans. It just had a lot of character. And so we really love that. It's in a great area. It's less than 3 miles south off Jones Road and West Road from another property that we own. So we actually split staff between the two of them. So there was a lot of economies of scale there. Again, big part of our strategy. The seller had owned this for 30 years. They bought it right after the developer had built it, and they'd owned it the entire time.
Wow. Now that is very rare. Jeez.
Yeah, there was actually a resident too that had lived there since it was originally built.
The mascot, if you will, for the property.
Yeah.
At that point, yeah.
Absolutely. So again, to your point, you don't see that very often. And if somebody's willing to hold something for 30 years, they've got to enjoy it, right? If you're not having a good time, you're going to sell it, you're going to move on, cut your losses. But if you've owned this thing for 30 years, that means it's treated you well. And they did the same. They treated it well too. But it was really a blank slate. It had original roofs on it. They hadn't upgraded any of the interiors. They did a good job when they were turning units because they didn't go back with random appliances, or sometimes it's enticing to maybe put a set of black or a set of stainless in there. But they actually kept it really consistent. So when an appliance went out, they replaced it with the same one. And that's really good for when we come and execute our value add business plan. So that's something that we really look for. If you've got 3 or 4 different levels of finish outs and they don't have a consistent way of a consistent system of maintaining the appliances and that sort of thing, it just creates a mess at the end of the day. We just really liked it was like a blank canvas that we could walk into and inject some capital into it and really make it look good.
One thing that might be helpful is because you were asking just about a little bit more about the value add and all
Yeah.
that. It was like Hayden mentioned, very much a blank slate. So we like that quite a bit. But we closed on it, I guess, almost 2 years ago now. So July of 24, finished exterior paint in short order, finished the roof quickly after that. Started digging into the units after that. And we'll see pictures of the units and then the clubhouse as well. We've got some before and afters there. I do want to mention though, the clubhouse timing was very strategic. So typically you don't want to do a clubhouse whenever it's here in the summer and you're really busy and you got a bunch of people coming in and all that. So we tried to time it to where it was over the holidays, to where it's the low period, all that people are typically not moving around the holidays and all
Nice.
that. So we tried to knock it out there and then we were able to knock out the pickleball court. And then we had 35 units complete in the first few months there.
Excellent.
Yeah.
That's really fast execution. You acquired in July, and by November, the roof was finished. That's familiarity with your builder, your construction team, and all that. It's like different project, but same team. And that efficiency, to your point, sticking with the same two or three teams over and over has a lot of synergy and a lot of relationship there. It's
Yeah.
really fast.
Yep. Whoops, let me go back one. And then just talking about efficiency and all that. These guys had owned it for 30 years. They didn't have to, the deals where people are flipping them every few years, like everyone that gets it, or like you got to push. But these guys didn't have to do that. They've owned it for 30 years. They were in a very comfortable cash flowing position.
Yeah.
And we were, just to be very transparent, it's been the past year or two has been pretty flat, honestly, from a rent perspective. It's been pretty challenging. And to be able to get 12% gain in income, I think just honestly just points to the fact that they didn't have to push. It was being operated well. They had great Google rating, Google star rating. I think they were at a 4.3. It was being operated well, but they didn't have to push. And then there were some just over the years, because they didn't have to push, some things on the income side. Because obviously, if the income's going up about 12%, the NOI is going up 49%, then there was a lot on the expenses that we could push on. Insurance was a really big thing. I think we renewed just a month ago, and we've brought it down again. So we're at $700 a door.
Man, that's unheard of. So that's just, I imagine you probably have leverage with all your compounds and units. So when you approach the same insurance carrier, it's a volume discount essentially. So yet another forte of having that concentration in one or two markets.
Yep. And then wanted to mention too, because we did increase the value here quite a bit, and we're not just telling you that or whatever. We actually went back to the lender. So I'm not sure if you're familiar with what a supplemental is, but it's basically the lender would potentially give you an additional loan on top of the one that you have. And so they had given us a supplemental loan quote for 1.4 million. So it's not just us telling you, it's it's not
Third
just
parties.
spreadsheet.
Yeah.
Yeah, the lenders are willing to give us more money based on.
You guys are very humble, but that is an incredible just product after 12 months. Again, for our viewers at home, to up the current valuation, just look at the purchase price and then the efficiencies, leveraging their business models, cutting expenses, and then a nice solid uptick. And anyone watching, the last couple of years of multifamily have been challenging for a whole slew of different macroeconomic forces. So you can't just bank on pushing rent. You really have to, it's synergism between cutting expenses and other things. So to do that in a 2024 market and pull this off is supremely even more impressive, because in a good market or in a strong bull market, anyone can meander their way towards numbers somewhat like that, but to do it in a challenging market is even that much more impressive.
And then Hayden, if you want to kind of give updates on the clubhouse.
Sure. Yeah. So we can show you a little bit about the before, how it looked when we took over the asset. So this is how it looked for basically 30 years. And it's not very attractive, but when we see this, we actually get really excited, right?
It's like HD TV. Yeah.
That's right. Yeah, we're
Yeah.
it's just flipping on a much larger scale, right?
Yeah.
And so it's got a lot of character, like we touched on. We just saw the potential of when you walk in this space, it's beautiful. It can make a really great first impression for those prospects that walk through the door. It's got those beautiful bay windows that overlook the pool. It's got coffered ceilings, had a great fireplace, and it had all the great spaces, right? It was laid out well. Your office is right there off the front door. You get a business center, you get a lounge area, you've got a kitchen where you can host events, you've got a gym, we had package lockers to where a old sauna room used to be that they were using as a storage closet. Um,
Nice.
a little strange. I guess that was an amenity back then, but that's no longer desired anymore. But yeah, if we go to the next one, we kind of see the after, and this really reflects what we do at all of our clubhouses.
Oh, nice, nice.
So
That's so clean, man. Nice.
yeah, much cleaner, brightened it
Yeah.
up a lot.
Yeah.
We redid the mantle there, so we did a custom mantle fireplace with the trim detail above it, all new furniture, new floors, new paint, new lighting. We carried that blue that we had talked about through here. And this community is an interesting one because, again, it's like Dustin touched on earlier. You've got to think about how you're going to execute or go about executing these projects because each one, these are huge projects and these are people's homes that you're dealing with. But additionally, at this community, we didn't plan on having a model. They didn't have a model here. It's only 148 units. Typically, for that size community, you really don't need one because every unit is almost a percentage of occupancy. So you really want to maximize that, right? You don't really start using models unless you're probably 175, 200 units. But we wanted them to have an idea of what their space could look like, even using this clubhouse. So we use the same countertops in that lower left-hand corner that are in the units, same style cabinets, same exact appliances. So we kind of fit this out, this little kitchen out. We actually knocked it down to make it flush too. It was a tiered little island there before, and we knocked it down and made it great for having events and stuff like that.
Yeah.
And then it's also a great illustration of what their space could potentially look like without needing to take up a unit as a model. So they can walk through here and still get a good idea because we use the same style floors,
Oh,
same
that's
exact
clever.
paint.
Yeah.
Again, same counters, kitchens look all the same on the interiors of the units, right? So
Nice.
that was again another marketing strategy that we thought of going into this deal because we knew we didn't want to take up another model, and we just seeing the space, we knew what we could do with it as well.
No, great job. Seriously, impressive team.
And then here's the exterior. Again, it was in good shape. Loved the character, but it was just tired. It was dated. Had a lot of browns. You can see there the trim and the doors on the lower right-hand corners. It's just very dark.
Yeah.
Doesn't feel inviting. Doesn't say live here, right?
Like a college campus in New England.
100%. That basketball court that actually looks better in that picture than it did in person. It was
Nice.
pretty rough.
Yeah.
But again, like that was another thing. It was a solid
Oh,
pad, no cracks in
yeah.
that pad.
Yeah.
And that would cost a fortune to put in.
Yeah.
And so to be able to turn it into a pickleball court with some seating,
Yeah.
that's literally just paint and throwing up a fence. That really didn't cost all that
Yeah.
much. And I remember I went out there the week after we had put that in, and people were already using that. And it was just
Nice.
the coolest thing to see.
Nice. It's a really clean look. I like the blues that you are using and different variants of the same blue and stuff, which is nice. Yeah. Gotcha.
And then, yeah, all right.
I bet you got
So-
excited the first time you toured.
yeah, yeah.
Yeah.
Wide appliances, dead giveaway.
Yeah. Oh man.
But yeah, it's not bad. It's just,
Yeah, the
it's
bones
definitely
are good,
dated.
like my wife says.
Yeah. There you go. Yeah. So it's a nice, clean, like I said, the asset itself had been run really well. Manager was doing a good job, good Google reviews, which is always, you can tell how well being run usually by that. But then the
Oh
afters,
man, yeah, no, it's
yeah,
so much cleaner.
very clean.
It's
Yeah.
nice.
Yeah. And one thing that was really important for us, just going back to the clubhouse, this, when you drive up, you have your first impressions and then of what the exterior looks like, obviously. But then
Right.
when you walk in, this is a glimpse into what a unit would look like.
Yeah,
And so this space in our mind is super, super important.
critical. Yeah,
And the pictures look really good, but
yeah,
honestly, it probably doesn't do it. When you walk in, you're like, oh wow,
nice.
it definitely leaves an impression. Yeah.
Very nice.
I think that's I can't remember if there's anything, yeah, past that, but yeah, it's just, this project's gone really well. And just one thing that's just big for us is just the attention to detail, and we're very hands-on. And then we have an asset manager that, she's awesome. She was with Greystar. Greystar is the largest management company in the country, and she was with them for about 17 years. She's done have at least every position in the office. I don't think she was on maintenance, but she started out as a leasing agent, worked her way up to regional, and then, so, and she's also was a asset manager for another larger firm prior to coming over to us. Super, super grateful to have her. Yeah, well, definitely not passing over anything on her. She's seen it all.
And then lastly, if maybe you can talk about the current markets, because I know you guys, obviously the bulk of it is in Houston, but you've also started moving in, you're active already and moving in the Dallas market. Maybe if you can touch on what drew you to that market, what different variables, what did you like from the market that kind of made you take that
Yeah.
step?
Yeah, so I guess I'll start off, and I'm sure Hayden may have some things to add as well. I guess I'll the last deal that I did was sold in Dallas in 21 or 22. And we've been trying to buy in Dallas for quite a while, and honestly had been getting beat out over the years. I remember in 21, 22. Now, looking back, I'm grateful we didn't win it.
That's right.
But in 21, 22, we were getting beat out by $1 million. We're like, oh my gosh, we're just getting our butts kicked here. And
Well,
so,
it emphasizes the importance of your underwriting is your underwriting. You guys are
yeah,
conservative, making logical steps. And the people that rushed in and overpaid are unfortunately people that ran into a lot of trouble a couple years down the road.
yep. So we like both Houston and Dallas a lot. We feel, because there's a lot of opportunity in both, but Dallas is it's a large market. Both are probably the two largest top five apartment markets in the country, just kind of in general. So yeah, we like both quite a bit. Tons of people moving to both, tons of jobs. So a lot about each of them. But yeah, Hayden, I don't know if there's anything else you want to kind of add.
Yeah, the fact that we have a presence there too is really valuable. So Dustin's based there in Fort Worth. He's lived there most of his life. I lived up there for about 9 years in the DFW
Nice.
area, and that's where Dustin and I actually met. But originally from the Houston area and back down here now because we wanted a presence in each of our target markets.
Great.
And so that's a big priority for us. And as you've kind of seen throughout some of what we've discussed, we like to be hands-on. We like to know what we're getting into. We want to invest in our backyards and we don't need to grow. That's not our interest. We want to buy. We want to buy right. We want to operate well. And this is a reputation game at the end of the day. And Dustin's son, Henry, his name's all over these properties. And so we've got a big reputation that we want to uphold. It's super important to us to do things the right way. And Houston and Dallas can keep us busy for so long too. Each of those, Houston's almost 8 million people now. DFW is 8.5 million. They're both kind of neck and neck in terms of population growth each year. Dallas is seeing a little bit more employment growth. You're seeing more, I think last year it was ranked number one for large headquarter relocations. So you're seeing a lot of employment growth really in both, but more so in DFW right now. And like Dustin talked about, we've been trying to buy since we teamed up back in late 2018 in Dallas, but we got beat out so badly because there was always a spread basically of what you could get in Houston. You're probably going to pay 20 or 30% more in Dallas. It's just a hotter market. The rents are a little bit higher and there's a little bit more hype around DFW. And as a result, the prices are 20 to 30% higher. We're at a point in the cycle though, where that's essentially gone. Dallas had a little bit more supply get built and for a little bit longer. And so that prolonged some of the pain that DFW experienced versus Houston, where the builders stopped building quicker. So that supply absorbed a lot faster. And as a result, the rents have actually held up better in Houston, which has helped price stability over the last couple of years. So Houston pricing bottomed quicker than DFW did. But DFW is, I would say, a little stronger of a market. So I think it's also going to rebound pretty quickly too. So that's where we see it as a window of opportunity to entry into DFW while there's essentially no premium baked into these bases that you can get these assets for. And we're being a lot more competitive in deals up there right now than we ever have been in the past. We've got a full staff too in our Houston portfolios. We've got 2 dedicated regionals just to our team. And so we've got it's a good balance in Houston. We're not at an in-between stage where we're not big enough to have that 2 full-time regional and we're not too big or anything like that. So Houston's a good sized portfolio right now as well. So I think it's just the perfect timing to really look at Dallas. It's been something that, like I said, we've been trying to get into for so long, and it's one of our backyard markets, and we're finally seeing the opportunity to do.
No, that's super exciting. And again, guys, huge thanks for introducing yourselves to our audience here. And again, that triple win between your residents, your investor base, and obviously your company. Always, those things are not mutually exclusive. And then the importance of nice, conservative, patient underwriting. At the end of the day, the people that ran into trouble in those choppy markets are the people that were a little too aggressive, a little too leveraged, obviously, and all that. But again, for our audience at home, this was a fantastic example of a top shelf operator, essentially, a Momentum Multifamily with both Dustin and Hayden. And if you want some free resources to get started, you can go to www.cardiarei.com and you can download a couple of books, 9-part academy, and hopefully we have the chance to corroborate and collaborate in the near future there. Yeah. So again, thank you, Dustin and Hayden, for your time.
Thank you. Appreciate your time. See ya.